Hi there, I'm demonstrating Eucles today. Eucles is a cost forecasting and price to win tool. I'll be giving you a walkthrough of a sample model, so please get in touch if you like what you see. So the first thing that I'm doing here is I'm setting up the work breakdown structure. This is being done using a document called the cost resource breakdown structure. Basically, it's a document released by the UK Ministry of Defence that gives a definition of all different types of costs, and we use it because I think it's particularly accurate. But if you're listening to this from America, don't panic because we've also got the capability to use your equivalent documents. Those are the MIL Standard 881C documents. And if you're not in defense, don't panic again because it's not just applicable to defense. It's really simple. It's just giving an indication of different types of costs and how to define them and what should go in different work packages. It's just really important for the granularity of the estimates that you'll want later. So I'm just finishing off the settings for a new project now. Those are the main things that I would do. I'd set up the work breakdown structure, I'd set up the dates and the economic conditions, and now I'm starting a completely new model. So that was just a template I picked up. I'm running a new model. So whilst that's loading, why would you be interested in a standardized tool in the first place? Well, in simple terms, you've got to consider that when you're doing a lot of different models with a lot of different people doing them, then it's going to be really hard to ever understand how good your estimates are if they're not in that standard format that you can go back and check and understand them and understand what assumptions were made. For example, if you're in a company and you're building some kind of aircraft, before you do your estimate, you might want to say, well, look, we built an aircraft 10 years ago. What were the assumptions we made then? How accurate did it turn out to our actual costs? And of course, if you can't find that model or you can't understand that model because the person that built it has left the company, if the model is a very bespoke structure that you can't get your head around, then it's going to be really hard to learn from that. And that's really one of the key benefits of having some kind of standardized tool like Euclid, that every model is in the same structure. It's still a very flexible structure. You'll see that you can use it in different ways, but you'll know exactly where to look to see how much project management they assumed, how many hours did they assume for the manufacturing in that aeroplane, how could you put that into today's economic conditions and see what that would come out with, how would that compare to the customer's cash profile. All those questions can be answered very quickly because you're not trying to understand the model, you know what the model is, and you're just going and getting the data. And that reusability, that's a very strong benefit of any standardized tool. So that ability to reuse assumptions. Most analysts that I speak to are having these kind of problems where they just can't get enough data to make the assumptions that they want for their models. And this is a constant problem across lots of organizations, anyone doing some kind of complex estimation. So when you're doing estimates, you want to be reusing assumptions as much as you can. If you've done a model that's done any kind of complex project, you're not going to be 100% certain about every single estimate in that model. But if your result turns out to be reasonably accurate after your organization's delivered the project, then you know that it's good enough to reuse a lot of those assumptions. You know, they're better than pure guesses now because they've had some kind of calibration in the real world. Okay, so that's all loaded now. We have a completely blank model. So the first thing we're going to do now is add in a new company. Now this might be your company, this might be a competitor that you want to estimate, or it might just be some kind of abstract name. So I'm just calling this a test company. Now, the whole point of doing this is because we want to be able to account for different overhead structures. And by overhead structures, we're talking about the way in which a company converts a cost into price. Okay, so we want to be able to look and see how the different cost buildup that we're going to model could turn out to be a different price depending on which company it was, or depending on different levels and the way in which the supply chain was modeled. Okay, so this is really important. And as we get into modeling some of the costs, you'll be able to see how this affects things. So as soon as this is loaded, what I'm going to be showing you is a list of assumptions about pricing, profit margins, about risk margins, overhead margins, all these kind of things. Now, of course, you're free to override the data. It's got some defaults in there at the moment, but you can put in whatever you like here. And the key thing about this is you'll be able to later, we'll show you how you can go into Companies House, which is a repository of lots of different organizations, and you'll be able to see what kind of margins you should be putting here for different things. We'll come to that later in the video. But now that we've created our first company, we're ready to start doing our first estimate. And I'm just going to go with a nice easy one now. I'm just going to do a bottom-up estimate of some project management. Okay, so I've clicked on a different part of the ribbon. As you can see, I've told it what I want to estimate, and we're just going to load up that, and we'll get on to making that estimate. Okay, so this is our estimate tab. I know it looks complicated to start, but you'll quickly get used to the interface and you see that it's really not that complicated. So I'm just going to do a bottom-up estimate right now. That means I'm putting in a bunch of resources. Now, Eucles comes with a bunch of data in it, a lot of economic data. It knows what different national average salaries are in different countries, about 26 different countries, but you can always add your own. It knows what regional differences are. So, for example, it knows how much more the southeast of England is in terms of what wages are compared to the national average. And we just gave it that kind of company overhead structure that we were just looking at there. So what it's going to do now when I give it these different inputs is that it's going to take the salary data that it has and it's going to turn that cost base into a price based on the default overheads that it has. So there's our test company that you just saw me create. I'm going to put that in and give it a head count, and then we'll see what that's coming out at. So obviously, I'm not thinking very much about what I'm putting in at the moment. These are just sort of semi-random figures, but I'm just trying to illustrate to you how the tool works, okay? So we've just put in 4 resources and we've got about 500,000 a year coming out, okay? And I'm going to put that into the estimate grid over here. So the estimate grid is present on all of our different estimate sheets. So you can see that in the ribbon, we've got about 7 different templates for doing estimates up there, okay? Now, all of these, doesn't really matter which ones you use, they're just some a bit more suited to different estimates than others. But they all have this kind of estimate grid in here that I'm filling out. So this is the part in which you communicate to Eucles exactly what you are estimating. So at this point, I'm telling it that I'm doing a project management estimate and that the figure I'm giving it is a full cost. Okay. Now this is really important distinction here because you can put in any kind of cost you want. You can actually put in a price. If you know the price of something already, Eucles can actually cope with that, and it will tell you later what it would assume the cost base would have been if you've given it a cost. Likewise, we can give it a cost here, and it's going to convert that up to a price very shortly. Now, the benefit of that is that you can deal with any kind of figure here. You don't have to be really specific. You don't have to worry about standardizing all these different things. That's exactly what Euclid is going to do for you. And that's going to save you a lot of time and a lot of headaches. Sometimes you're going to have a piece of information where someone will say to you, hey, we're buying this product from someone else and it's costing this. But what does that actually mean in terms of a final price that you're going to sell to a customer at? Well, actually, Euclid will tell you that. All you have to put in is that price that you're buying in that material for. So I'm going to put in one more estimate sheet. This is just a slightly different template. You saw me click on there. This is for dealing with materials. So this is just a really basic model that we're building here to show the process. And then we'll be done with estimates. So I just want to put in, buying some kind of material, and you'll see how that goes into a different part of the estimate grid. The company tab that we looked at before will add different overheads onto it, and you'll just see a bit of different treatment. Now, that was a project management estimate that we were just doing. We could create as many of those as we wanted to. We did this one bottom up. We might take some comparative figures from a past bid. We might take some parametric estimates. And the thing is, you can add as many of them as you want. They'll all just be selectable when we get up to the final sort of, we call them solution tabs. So this is where you put all those different estimates into coherent solutions that can actually be offered to the customer. So when that happens, you'll be able to see them all, put them side by side, do the comparisons and calculations. So here you see that we've got a different estimate template, but again, on the left-hand side, you see the estimate grid. Okay, so all of these will always have that estimate grid. Now, Euclid always has a bunch of economic data in terms of inflation figures and things like that. So here I'm going to tell it that actually I know that this radar was £1 million back in 2012, and I can set different inflation rates, different currency rates, and I can say that that today in the economic conditions 2017 that we're looking at is going to be worth that. Okay. Now I'm also going to tell it that that's our cost base. Okay. So that's what we're making it for. I'm going to plug that in. And when we get onto the next lot of tabs, you'll see that actually we're going to turn all of these into prices. So I've given it 2 different types of cost. So that is a cost without all our indirect overheads on, and Euclid will account for that because I've already told it that this is a direct cost. And the labor estimate that we had before, that's not going to add on indirect overheads because it's already got them. It's going to just add on sort of profit margins, other things like that. So that's how I'm communicating to the tool now. Okay, so that's obviously a really simple bunch of estimates, but now we're ready to start adding our solutions. So what this is doing is putting all the different estimates together into some kind of coherent solution that could be offered to the customer. We do encourage 3-point estimating, so I'm going to start by creating a minimum one, and then I'm going to add a most likely. And what this allows us to do is look at all the different estimates that we've been producing. Obviously, there's only 2 in this model, but there could be loads. Again, I could have done different types of estimates of this radar, and to experiment with them to put combine different ones. So I could do a parametric estimate of the project management and put in a bottom-up estimate of the radar. I could take a comparative figure for the radar and put that with a bottom-up estimate of the project management, all these different things. And I could play with the supply chain as well. I could say, what if it was this company supplying, what if these companies formed a consortium together as opposed to one company direct, all these different things. So this is where I'm going to set the supply chain, but again, I'm just going to use the test company that we created just for this model because I want to keep things relatively simple at this point. And then we see the WBS, and that's what we are setting up at the start of the video. That's here. We've got different levels for the company that we're estimating. We've also got some work packages in there to account for the customer's own costs and for the cost of customer costs that have gone external. Okay, so by that I mean that the customer might have had to pay for some technical studies to be done, some feasibility studies at the start of the project, and we need to account for those costs in terms of deducting them out of the customer's budget, so we can see that our overall offer is still affordable in the context of the whole budget. But the tool understands that that's separate from the price that we're going to submit to the customer, so we're counting them differently. Okay, because say we like to encourage the 3-point estimating, I'm going to also set up a most likely tab here, and then we'll do a maximum one. But in the drop-down list you saw on the left, that's where all these different options would appear. So if I did more estimates of the radar that we're just looking at, they'd all be selectable on row 7 there. So then we're going to hit calculate once I've finished adding all of these in. And we're going to see a lot of information on this tab. It's actually at the bottom of the tab. You can't see it at the moment. But what that information does is it gives us a whole bunch of it tells us what we've assumed, it gives us all these assumptions. And that's really powerful because, as I said, we can give the tool all sorts of different figures about this was the price of something, this was the cost of something, and everything will get converted eventually into a price. But sometimes we also want to see what we have indirectly assumed going backwards about, what the total cost of that would be, what the overhead element of that was, all these different things. And actually, we're going to calculate that automatically as we go with the tool, and so that's going to be really useful for us to cross-check. So we're almost ready to hit that calculate button now. As you can see, we're setting up just the max estimate now. So one of the real benefits about doing real pricing estimates in the UK is that we have access to private company information that just isn't available in countries like America. And you're going to see, I'm going to hit calculate now. Okay, so the model's going to take a little time just to calculate those sheets with those assumptions, but whilst that's going, I'll just explain. In America, private company information is held private, the public can't access it. Now, we have some really big government contractors in America, and a lot of the same ones are in the UK and other countries as well. So in defense, you have companies like Raytheon, Lockheed Martin. In transport, we've got huge companies like Bombardier, for example. If you're in telecoms, obviously you've got giants like Vodafone, British Telecom, people like this. Now, any of those kind of companies are actually those names that I just gave you are really the name of the holding company. Okay, actually, they're made up of loads and loads and loads of smaller subsidiary companies. Now, what I'm saying is that in countries like America, you can't really see that. You just see financial reporting at the top level. Whereas in the UK, actually, all those different subsidiaries that they set up have to be visible at a place called Companies House. And the value of that is that you can actually see the specific business unit of Vodafone or Bombardier or Raytheon that you want to model and see exactly what that overhead structure looks like. So I'm just going to bring a sample onto the screen. So this is just a particular company, but you have all this information so you can see these figures, and don't memorize the figures, but just remember that here we could see the selling and distribution costs, we could see the administrative expenses, we could see some information on on their balance sheet, but also even some more detailed things. The vast majority of these will have in there their number of employees they have, what their wage bill is. Okay, see these numbers here. So this is going to be really key. Okay, so as soon as this is finished calculating, I'll show you how that relates. And actually, the point here is that we can calibrate our assumptions because these subsidiaries don't tend to be that big. Generally, a lot of them might be sort of only 30 million pounds. Put in your head sort of like $50 million there. So actually, if we're working on a particularly large estimate, that might account for sort of 60, 70, 80% of their future turnover. So what we've got is a bunch of indirect assumptions that we've made about how that company structure will look like in future. So we can sanity check that against how it looks today. Okay, so now that that's finished calculating, we're going to look at all the different results that we've got. We've got a maximum value of 4.4 million, a minimum value of just over 4 million, and a most likely value of 4.2. But also I just want to draw your attention to some of the other calculations that were going on while we're waiting there. You can see that Eucles has automatically calculated the overhead structure by year of the different pieces, so we can see exactly how much overheads we've assumed in the different parts. So this is really important because we only ever gave Eucles one figure, but actually it's been able to calculate all of those different ones. Okay, that's really important because we're going to get lots of questions about our analysis. What have you assumed about X, Y, Z? And if you start with a price figure, then you don't really want to be reversing back to that. You've got the figure automatically calculated there. So if you're getting asked about this in some kind of review scenario, you can just go straight to that tab and look at what the figure was. Now, we're finally going to be ready to combine, so this is for people that are doing bidding now. The cost forecasting side of things is almost done, but we might want to add in some different technical scores. So there's a tab here where we could put in some technical scores. We're not actually going to do anything there because we've only got one set of estimates, but I'm just showing you that to show that we could combine it. So we're going to do a calculation now using another add-in which is sold separately called at risk. Now, just to be clear, there are lots of different tools that do sort of Monte Carlo analysis. At risk is just one of them. It's just the one that we prefer. It's not the one that we make. We buy it from another company, but we work with it because we've got our 3-point estimate on the screen there. And what we want to do is put that into some kind of distribution. And if we're doing some kind of bidding scenario, if you're using Euclid for price to win, which is what most people do, then we're going to want to combine the technical score of different companies. Okay, so at the moment we've just got one other bidder modeled, what their price would be. We haven't really changed anything about the technical score, so we just got a fairly standard distribution there. And what we're doing now is we're running the Monte Carlo simulation, just a nice sort of simple one. And that's how we're going to get the final price to win graph, which is just the same as what you'd use for cost forecasting as well, if that's what you're using Euclid for. But that graph is the one that has the final probabilities of winning. So that what you're saying is that, if we go in at 4.3 million pounds, we have this much chance of winning. If we reduce that price to 4.1, we can actually see how much our probability of winning increases. Now we should note that we're not going to make the same amount of profit at 4.1 as 4.3 million pounds, but that's really where we get into making the best decisions for the business at the point in time. We don't want to win business where we don't make money. We just want to be able to be in control of that exercise. So we're not guessing basically how likely we are to win. If we have these kind of probabilistic distributions, we can see, do we win 6 out of 10 bids where we bid at the 60% P win figure? Because that's how we can constantly go back and check that our estimates are accurate, that our figures are working. And when we know that that's happening, and that really shows you the value of having this standardized tool and this standardized template. So I'm just waiting for at risk to run now, and then we'll go over to the right hand side of the tab, and then we'll be able to see these kind of blue price to win graphs, which is what we advertise in all our marketing material and everything when we present price to win. So we're almost at the end of the model now. So now that that's calculated, we're going to go over to the right hand side of the model, look at our results. We've spent probably the best part of 30 minutes on this model so far. Obviously we edited out some of the waiting time because it doesn't make for great sort of viewing there. But here we go. These are the infamous graphs for price to win and cost forecasting. Most people will be familiar with this approach with the 10, 50, 90 sort of concept you get from 3-point estimating. And this is now finally telling us this is a price to win as opposed to cost forecasting. This is telling us now that if we bid at £4.2 million for this opportunity, we have a 60% probability of winning. So if we bid at this number, then we'll win 6 out of 10 of those bids. If we lower that price to £4.1 million, we increase our probability of winning to 80%. That's what the information is doing. So as I say, we spent about half an hour creating that model. Now that might seem like a lot of time, but honestly, you try and create a model like this from scratch, it is really not uncommon to find people spending days and even longer on these kind of models. So it's quick, it dramatically reduces the amount of time you need to model, it gives you real assumptions you can calibrate against real data. As I say, we have a lot of that we can talk to you about. And the biggest benefit is going to be the standardization. It doesn't matter which analyst in your company created the model, you can go back and look at models in history, everything will be in a place that you recognize, and you'll be able to keep reusing assumptions over time, which is what gives you the confidence going forward, because you've been looking at these figures. You know that when you bid at the 60% figure, you're going to win 6 out of 10 bids, and you know that you can reuse assumptions because you know that they're valid. And that's how you really get good at estimating and really get good at price to win.